In today's video, I'm going to show you how to build a 3 financial statement modeling. It's a very common practices in finance accounting. If you're in intro finance accounting classes, corporate finances, it helps you craft a simple picture of a business model and how the money flows and what it's going to look like when you're growing a business or when you start making money. And the business that we're using today is a simple lemonade stand. Okay, any kids can start a lemonade stand. Let's say you want to start a lemonade stand and selling some lemonade, but you want to also see what does it look like in terms of a financial statement, or at the end of the year, your accounting statement, what it looks like. Okay, helps you a lot with visualizing business and numbers on paper. If you don't know who I am, I'm Ricky. I'm a founder of the Thai Academy. I help tutoring students and along with their classes in economic, finance, and accounting. I've been doing it for 10 years, so today I'm going to show you how to do it, a simple one from my practices. Okay, so let's dive into it. So business is, again, it's a lemonade stand. Okay, now in any business, I'm going to zoom out in a little bit. In any business that you're starting, there are 3 kind of financial statement. The first financial statement, okay, number 1 is your income statement. Okay, your income statement is the statement that generate whatever the activities that is happening. Okay, so it's going to consist of revenue, okay, which is the sales that you're making from selling the lemonade and the money that you receive from customers, and it will have the expenses. Okay, now again, this is for basic visualization of what the business look like. I'm not going to go into detail at corporate levels where you have to pay, see all the different kind of expenses. So I'm just grouping them all into the income, the expenses, and the net of those two, which is called the net income. Okay, in reality, you have taxes, you have to pay taxes, you have to pay interest rate, whatever it is, but those are for higher levels. But today we just keep it simple. Okay, the net income is whatever left from the business. And now this business will have some, I call it timeline, right? The time that you're starting the business, I call it year 0, which is today that you want to start the business. And then it goes along the way, right? You're going to have year 1, you have year 2. Okay, and let's say we're projecting this business for 5 years. Okay, so year 1, year 2, 3, 4, and 5. Okay, and we will see what the flow of the money looks like and how does it flow down into your balance sheet and your cash flow statement, which is the other 2 statements I want to introduce here. Okay, so the second statement is the balance sheet. Okay, so the second statement you have is the balance sheet. Now, the balance sheet will consist of the asset, call it, let's say, the asset category. Then you're going to have the liabilities. So the second is liability. Okay. And the last part is the equity. Okay, so if you're getting into business and accounting, you understand the balance sheet. You need to understand the balance sheet more, and the asset will equal to the liability, the debt that you are borrowing, and the equity, the money that you put in to start the business, to start creating that asset inside the business. Okay, so I call it equity. An asset will equal to liability plus stock equity. Okay, so under the asset category, you have the things called the cash that you put into the business, right? So I call it cash. Okay, and liabilities, one of the common liabilities is called the debt or borrowing. Okay, so debt, borrowing. So this is the money that you either go to the bank, you raise them, borrowing from the bank, you pay down interest rate, or you're using money that you make, you're out of your pocket money, they call it equity or owner contribution. So at the corporate levels, they call it common stock, but I'm just gonna say owner contribution. Okay, so that's an easier term for you to think about when you start a lemonade stand. Now, this equity will grow over time if you start making money, right? So think about it, right? If you start with some money, it will grow over time. Like, where do you put that money into? There's a section called retained earning. Okay, retained earning is whatever the money that you make from your net income, and then you retain it into the business, not taking it out. Because when you take things out, it's called owner withdrawal or owner distribution in terms of dividend. So in this, for the simplicity of this exercise, I will not include owner withdrawal or owner distribution. I'll just keep it as owner contribution, and we retain the money inside the business. Okay, so you retain that money in the business. So it's another category. Now, because there's 3 sections, we want to sum up each sections to see how all the category combine together. So you have the total asset, which is the sum of the assets inside of it. Okay, you can also have total liability, okay, which is the sum of all the category inside of it. And then total equity, okay, which is the sum of all the components. I should say components, right, inside of this section. Okay, so we are done with the balance sheet. Again, the balance sheet also carried through each period. Okay, and then also equity, it also carried within each period. So, okay, now when you build the balance sheet, one of the common rule that all the finance guys pay attention to is the asset equal to liability plus stock equity. We also want to have a section of total liability plus total equities. Okay, and I'm just going to add these two together to make them sure that they are equal. Okay, so that's very important for the cross check. Okay, and I'm just bold these out so you can see each sections that we require, that is important. And then the last statement, which is very important for a business, is the cash flow statement. Okay, so this statement will tell you how the cash are being generated or coming in and out of your business. Okay, sometimes net income doesn't tell you 100% that the cash is actually flowing in or flowing out of your business, because customer can promise to pay you, but they haven't actually give you the cash yet, but you still record the revenue because you make the sales already. The cash flow statement is a much better metrics to measure the cash actually generated or actually paid out to that the customer pay you or you pay out to vendors, let's say. Okay, so that's the importance of cash flow statement. It also goes from today period to the next 5 years. Okay, now the cash flow statement has 3 sections. Okay, the first section is the cash that is generated from operational or operating, cash from operation. Okay, this will consist of the net income of your business. Now, in detail finance classes, you will have a thing called depreciation, which you add also into the cash from operation, and change in net working capitals, which is the change in current assets and change in current liabilities over the period. But for the simplicity of this 3 model statement modeling, I will leave these things out. So we'll treat net income as 100% cash generated from your business, which means the customer buy your lemonade, they pay you right at the spot. Okay, and you're gonna have a total cash flow from operation. Okay, so it's going to be the sum of whatever the components that is inside of it. Okay, and then the second thing is the cash from investing. Right, so investing here means that you're actually spending but for the future growth of the business. Okay, a category of cash from investing can be spending on either big spending, so either machines that you're building, computer that you're building, or the lemonade stand itself that you're actually spending on the investment. Okay, very important to treat it as different from traditional expenses, because these are smaller item expense and it doesn't meant to generate revenue, or it's not treated as an asset investment. Okay, so cash flow from investing, there's one category, that many finance, we call it is CapEx, or capital expenditure. Okay, so it's another short word for it is CapEx. Okay, and when you're starting out, okay, I'm going to treat it as zero at first, but we also have the total cash flow from investing. So right now it's the sum of this balance, okay, this activity. So we have the second category, cash flow, in the cash flow statement. Then the last category of cash flow statement is the cash from financing. Okay, now cash flow from financing would determine based on the activity we deal with the owner, okay, or the activity we deal with the debtor, or people that we borrow from, banks, family, friends, who are we borrowing money from. Okay, so these are meant to put the money in the business or take the money out of the business. It's called financing. Okay, different from the business activity like operation, where you're doing business generate revenues, or investing, spending on capitals, spending on machines to grow the business. Cash flow from financing is just dealing with the owners or the debt collectors. Okay, so there's two categories that I want to introduce here, components that I want to introduce here from cash from financing today, which is the owner contribution. Okay, so that's one, and then debt payment. Okay, so these two are very critical for our cash flow from financing. And also we're going to have the total cash flow from financing. Okay, so it's the sum of all the financing part here. Okay, so right now you can pretty much see like how we are starting out with the lemonade stand based on the spreadsheet. Okay, so in reality you will have technologies, if you're syncing your bank with QuickBooks and everything, they can show you right away how you're starting out, but this is just teaching you how to think the flow of money from the beginning until the end. Okay, so again, I'm gonna make sure I'm bolding this, and later on you see how function playing out with the business. So there's two more components that I want to show you here in terms of accounting and finances. Whenever you have the cash flow statement and there's three activity, you're gonna have the net change in cash. Okay, net change in cash means that the sum of all these cash activity, right? Is it going up or down? What is the sum of it? Will tell you how cashes are being generated or reduced in the business. Okay, and this net change in cash will add into the beginning cash. Okay, we add the beginning cash to generate the ending cash. Okay, because beginning cash is right now we pretty much can see it's zero. Okay, so we're not starting it out with it, right now we're not adding any money in, and then the ending cash is the net change plus the beginning. Okay, so to give you the ending. Okay, so now how does this play out? Okay, so I'll highlight these to separate the three financial statements and how the functions are played together, and you see how the money flow. So first, let's say you want to start a lemonade stand and you're thinking, I'm gonna put $100 into this. Okay, so you're gonna put your owner contribution of $100. Okay, now that's gonna make your total equity goes up by 100. Okay, and you see, then you need also some support from parents and family. Let's say you want to borrow $100 from your moms and dad, right? So get another 100. That's gonna make your total liability and equities to 200. Now that means your asset with cash gonna go up by another 200, right? Because asset equal liability plus equity, making an asset of the business. So this 200 will consist of 200 in cash. Okay, that makes your total asset of $200 here. Now, because you're starting out, you haven't do any business yet. You just set up your business. This is just like a setting up stage of your business before it starts running. And that means you don't have revenue, you don't have expenses, and your net income is equal to, I'm not going to sum these, but I'm going to do the difference between these two. And I'm just like bold this, okay, along the way. Awesome. Now I'm going to correct one myself here. remember the ending cash here, which is the net change plus beginning. This beginning will equal to, okay, to the cash that we are putting into the business. Okay, so we're starting out with 200 in ending. Now, let's get this business rolling, right? So let's say from the beginning until the first period, the ending of that first period, right? Let's say you start in January, which is year 0, you end at December, year 1, you generate some revenue. Okay, so let's say that you generate $100 of that revenue. Okay, so you put $200, start a lemonade stand, you make $100 out of those revenue. And you're gonna expend around 40% of those $100 that you make for ingredients, for the cups and whatever, the lemons that you're buying from the store. So you're gonna spend $40 out of those expenses for ingredients, plus whatever that you pay yourself, your labor. Okay, that makes you net income of 60. Okay, now where's this 60 gonna go? The first place it's going to go is it's gonna go to the net income right here. Okay, so this 60 will go straight to the net income, making the total cash generations of $60. Now, in this period, you're also decide to retain the $60 in the business. Okay, so that means that you're gonna retain, okay, the net income into the business, but your retained earning is at 0 at the beginning, right? Because you're not actually making money. So the retained earnings is equal to owner contribution plus the $60 into it, right? That's gonna make your retained earnings of 160, okay? Making your total equities to $160, right? Remember, you start with 0, you make 60, when you put 100 in, your retained earning is $60. Now, because you borrow some money from the family, let's say that you promise to pay them back around, let's say $10 a year, right? That's gonna go to the debt payment, okay? So $100 a year. So it's gonna be negative $10 a year, my bad, okay? Now, at first I'm missing something. Remember, I forgot to put in the 0 for the capex, because at first you're not spending anything. Assume that you are, starting it out, no capital expenditure, like very non-capital intensive business. And owner contribution, you're putting in $100, remember, and $100 debt payment. Ending cash is $400. This is something wrong here. So you don't have any beginning cash. Okay, so your ending cash should be $200. Okay, you're adding $200 into the business, making the ending of $200, similar to right here, your cash. Okay, this cash is equal to, again, I'm gonna fix myself, of 200 from the 200 pulling out from the ending here. Okay, so right there. All right, so assume that I'm not making any capital expenditure from year 0 to year 5. That means like I'm just continuing to do business. Nothing fancy, nothing happened. And then I don't add in any money along the way. So I'm not contributing any money. All the money that I'm making is I'm re-entering back into the business. Okay, now the next thing is we want to do is, okay, I want to see how much equity and total liability and equities is going to come out. We can see that after the first period, we have to pay down some debt. So the cash flow from financing is -10. Okay, we have cash flow from operation. There's no investing. Okay, oh, hold on, let me see. No investing. Now that means the net change in cash will be $50. Okay, remember, we are making $60 for net income. We also pay down the debt for the people that we borrow from, $10, right? That make the net change in cash of 50. And beginning cash is going to be the ending cash of the previous period. That's going to make our ending cash goes up by $250. This $250 at the end, okay, very important, because we are going to make that represent the cash in this period, which we have the formula up here already. So if I drag it out, you see it's 250. Your total asset will also go up by $50 from 200. Okay, now the debt borrowing is interesting because remember, we borrow $100, but we pay down $10. So how much do we have left? It should be $100 minus, actually it's going to be plus here, the amount that we paid out that make us 90. Okay, so the total liabilities now is $90. Okay, so can you check what's happening? 250 is equal to, let me see, total asset and total liability and equity. It should be equal. So you see there's two periods we are able to make the balance at the end of the year match, equivalent to each other. Okay, I'm going to add the net income. There's nothing, there's no net income right here. Okay, so if you set it up correctly, whatever you're projecting for the next 4 years will allow you to come up with the picture of the business, how it's going to operate and where the money is going to flow. So let's say that I'm going to grow this revenue at 20% a year. So that's going to be whatever in the beginning, use the formula 1 times 1 plus to the growth rate. Okay, so 20% growth rate, I'll be able to have $120. If I keep growing at 20%, I'm going to have around 144, 173, and 207. Same with the expenses. Let's say the expense grow at the same rate as the revenue, right? Because like, you know, more revenue you make, there's going to be some expenses that grow, but I'm keeping it consistent. So 40 times 1 plus 20%. I'm going to pay down $48 again, 56, 69, and then 82.9. And I can drag along the way to see what my net income is going to be. Okay. Now, from there, where's this money go? We can, if you set up your formula correctly, your net income will flow through correctly. Okay. And since we don't have any recapital investment, we can continue to pay down these debt. Okay, of $10. Your owner's contribution, let's say you're not adding in more money into the business, you're going to reinvest whatever you have from the income that you're generating. So your cash flow from financing is the same rate paying down every year. Your net change in cash will keep being the same, where it's just like the sum of these three type of the cash flow. Okay, and then let me make it nicely. Okay, and then in the end we will have around 312, 338, and 596 in ending cash. Where is this going to go? It's going to go up to the cash up here. Okay, and then again, I'm just keep dragging. If you set up the formula correctly, you will be able to have the balance sheet, you know, flowing through nicely. Again, debt borrowing 90, 80, 70, 60, 50, right? You're paying down those debt every year. So the balance is supposed to go down, right? You're not going to keep the same balance if you're paying down those debt already. You're not making any owner contribution. So what happened is that your owner's formula will stay the same. Okay, this plus whatever the contributions that you have in down here stay the same. And over time, you will see that you only contribute this much, but your retained earnings will grow because you're making more money. Remember, okay, you're making more money up here, and then your equity also supposed to grow. Okay, now the last part is we want to check if the total liability and equity that we make is equal to the total asset. Okay, so if I drag it out, you can see that right now it's not equal, and it happens all the time. Like, you know, your assumptions, your business forecasting will not always equal. So you have to go back and do a little bit of checking. Okay, so if I'm checking my retained earnings, I can see that, okay, it's the difference. It's the sum of total liability and equity. There, I have a little bit short in terms of my liabilities and equities for comparing to total asset. Okay, so let's check my equity. Is it correct? Okay, now let's check retained earnings. My retained earnings is equal to owner contribution plus whatever net income. Okay, I'm missing something. Retained earnings is equal to owner contribution plus the current retained earnings, and then plus the next year earning. So if I'm checking this here, I'm still missing the retained earnings at this period. You can see, right? So I'm supposed to have it grow consistently over time. Let's see. Okay, so there's something wrong here. So there's something wrong with the retained earnings. So let me correct myself first. Okay, so retained earnings in the first period is not actually 160. It's actually only $60 from the previous retained earnings. The correct formula, this is the wrong one, supposed to be previous retained earnings plus the current retained earnings. Okay, and then This period is supposed to be, I'm not contributing any capitals because it's already in here. It's going to be previous retained earnings plus whatever the earnings that I have. Okay, so I continue to drag it out. Okay, that's correct. This is the formula for retained earnings. So sometimes you would get tripped into where the owner contribution and the retained earning of the business. Let me explain a little bit about retained earnings. Retained earning is whatever the money that you're making, okay, and you put it back into the business and not paying yourself, not paying out to the owners. Okay, not the salary one, but taking it out from the business. Okay, so let's say you make $60, you decided to keep that in the business. Otherwise, you're gonna pay it out as a dividend. Okay, so this 60 keep being kept at the business as retained earning. The next year, you make $72 net income. You decide to keep it again into the business. It makes from 60 become 132. On top of what the money that you have in the business. That's how you grow your stake in the business, your equity, right? Assume that you're a one-person business, you own this 100%. And that's where how your wealth, your net worth is growing over time, okay? A lot of the time we think of the total asset here as a metric for how big you are. But remember, you still have debt that you're carrying in the business, okay? So these debt require you to pay down. And how do you pay it down? Well, you pay down with a portion of your net income. So you can pretty much see that the net income that you're making is not fully 100% retained in the business. A portion of it get taken away from the business because of the because of the debt payment. Okay, so you can see, okay, and then you grow your equity. However, your liability is also like a constraint of your growth. So that makes your liability and equity only grow to 50. Assets actually grow only 50 because remember, you're paying down those debt. You have to get rid of these debt. If you don't have the debt, you may be able to retain the $60 and growing your asset at the rate of your net income, which is $60. But in fact, you only grow at 250. So the debt that you borrow here create like a little bit of constraint for the business. So you have to pay them down first. Okay. Other than that, that's the goal of seeing how the financial statement play out together, how the money flows from one statement to the second statement to the third statement, and how you can use that to project what your future earnings is going to be. So if you have this model correctly, yeah, hopefully, right, knock on wood, you can change some of the numbers. Let's say on year 3, I make a lot more money than I have. My total asset and the liabilities are still equal the same. So the money will play out very nicely. Okay, so that's the rule of accounting. That's the rule of business accounting. Finance is how the financial statement flow together. If you like this video, make sure you hit subscribe for more future videos of explaining math, business statistics, and more of my tutoring sharing with you guys.